I'm going to lift my target. I think silver will go berserk. On the other side of this congestion zone will be something that will drop jaws and be so rapid, so quick that people just won't understand it. It wouldn't shock me if you hit $1,000 mark on silver at some point in the next year.
So if silver is going to enter a new reality, what is that going to do to the silver mining space?
I'm rampantly bullish on the silver miners. Not only are the miners going to revalue themselves, but they're likely to do it with extreme speed. And you'll see a lot of latecomers suddenly rushing in. They'll start hearing the headlines that we already know exist. The earnings are off the page. The profits are off the page for the miners. Yet it's been more.
Michael Oliver, great to have you back on Commodity Culture. I want to start by revisiting your call for $300 plus silver. Now, it looks like the metal could be staging a comeback since that significant correction we've seen after hitting new all-time highs earlier in the year. I'm wondering, at this point in time, what are you seeing ahead for silver for the remainder of 2026?
Oh, wow. I'm going to lift my target. And I don't mean lower it. I mean, probably lift it. And I'm not going to put a number on it. I'm just going to say that I think silver will go berserk. And the reasons are there's multiple reasons. We can get into those. But yes, and the action last week turned up our intermediate trend metrics, momentum things. Now, what I mean by that is when you look at long-term analysis of silver and gold bull trends, like annual momentum, so forth, the break was a nice break, but it didn't break anything. It didn't break any structures on momentum. So the long-term trend remains positive. That was a negative zigzag and a positive trend. So, but when we go down to more intermediate technical factors, things that come and go in a matter of a couple months or several months, they turn negative. They turned negative about in March, really, prior to that war break. Okay. But since then, if you stand back and look at a silver or gold chart, go back to that break that occurred in late January, early February. It was really about a 2-day break. People don't realize it was like 2 days. Bam. Silver hit a low of 63.90. Whew. And then went back up to like $90 and it came down and made another low at about 61. Didn't fall apart and turned back up again. Teasing rally. Then came back down again, got to about 56. Okay. But right now we're trading 65. Okay. We're back above those lows, all the lows that occurred, the sequence of lows. But if you think about it, all those lows were like marginal teasers. The real low occurred 2 days after the high in February. And so since then, you could draw a line sideways on silver and say, well, yeah, it's still under pressure, but it really isn't going down much since 6 months ago. Okay. So somebody's been buying that beast down there. Okay. Same with gold, same sort of pattern of a low in early February, then another low in March, and then you get the point. The upturn we just had last week on most people's charts say, well, it's just another rally in this nonsense range. You know, it's no good. It's just or sell the rally. Okay. But when you look at momentum, it says, no, this one's different. This is a rally that will likely sustain and work its way back to and through the highs. And I don't think it's going to take a long time. I think it may take like a month. Suddenly you're back up well off the lows and challenging the highs. But forget that. The issue is, where are we going? And a lot of people make the mistake of taking out their old daily price charts or weekly charts from 1980 or that second high we made at $50 in silver in 2011. And they say, well, you know, we just collapsed just like that 1980 peak, and it took them decades to get back up again. Okay. Well, you know, that's assuming. Don't look at the old arithmetic charts. Look at a ratio scale chart, a percent scale. We've run these charts before, but think about this just for a moment. You don't have to be a technician. Metals. Let's see what metals here I got. These are just examples: lead, steel, zinc, aluminum, copper, all base metals, and gold. Where are they trading right now versus where they made their highs back in 1980? About 4 times that price level. Okay, 4 times. Gold's more than 4 times where its bear low was in 2015 or where it was in 1980 when it made a peak at 850. Multiply that times 4 and you're above that level. Silver's what? Trading 10, 15 cents above its 1980 high. So let's say silver made a mistake. Supply demand mistake. We know we have a deficit. It's been for 6 years or so where we're not producing enough silver to match the demand. And yet that's ignored. The fact that most metals on the planet are 4 times where they were in 1980. And yet silver is overdone, with a pullback recently to a 6 cents above its 1980 high. I mean, give me a break. Okay, so what caused that? Well, I don't have the answer. Some people I respect do, and they argue it's been actually manipulated by major banks, perhaps working in shoulder to shoulder with the central bank. I don't know. Forget that issue. But obviously, silver, for some reason, has not moved in reality with every metal on the planet. And its mama metal in the monetary sector, gold. It moves with gold, right? Okay. Well, how come when silver back in 1980, for example, was what? 6.5% of the price of gold. Divide an ounce of silver and an ounce of gold. Where's silver right now? About 1.5%. What's going on here? We don't need silver anymore? It's not money anymore? No. Silver made a mistake. And therefore, to get back to the first issue about where we're going, even if it went up fourfold, which would put it, $200 silver above the $50 high, that would be normal. But most markets don't move when they make a big mistake for a protracted period of time, like way too high for too long or way too low for too long. When they compensate for the mistake, they often do 2 things. One, they compensate with speed, that sometimes is shocking, and 2, an overshoot of reality. Okay. And of course, if silver goes up in another leg here, another extension of this repricing new reality, these other metals aren't going to be sitting there at fourfold. They'll probably be at sixfold, sevenfold versus 1980. So silver's not going to go to 200 fourfold. It's probably going to go much higher. And I don't want to pin a number on it. It wouldn't shock me, don't chuckle, if you had $1,000 mark on silver at some point in the next year. Okay. Because there's a lot of things going on out there. We can get into that.
Yeah, I've actually had Lynette saying point to potential for $1,000 at some point if the true value of silver was to actually be reflected in the price on our screens. There's a couple other people who've also pointed to that figure I've spoken to as well. So I don't think incredibly far-fetched. Would love you to dive a little bit deeper there into what you were alluding to, into other factors that you think could be driving the silver price higher outside of just the technical indicators and everything you've laid out for us there, because there's also a narrative going on in terms of those who are bearish that silver is actually no longer a monetary metal. We have now seen the Bank of International Settlements declare gold a tier 1 asset. Central banks are accumulating gold at a rapid pace. It's very largely kind of making a re-entry into the monetary system in some form or another, not transacted as money, but it's being taken very seriously as a monetary metal by institutions worldwide. Silver doesn't necessarily have that going for it. Is that kind of bearish view, is that legitimate in your view? And anything else you could shed light on in terms of the drivers for silver ahead?
No, I don't think it's legitimate. I think it's somebody looking for an excuse to why silver didn't go up like gold. Okay. So they say, whoa, China's buying gold, not silver. Okay. Well, I think India is actually heavily involved in silver right now and even moving toward monetizing it maybe. But for 3,000 years, silver's been money. Poor man's gold. Okay. With official government stamps on it even. Okay. So no, I don't think suddenly now because somebody wants to explain why silver didn't match gold, it's not money anymore. We suddenly decided. Well, we'll see. Okay. I don't accept that argument. I think what's going to happen is silver's just simply made an error. A lot of markets do. And whether that was in part manipulation But it's when it unleashes, it goes to a new reality. It likely will overshoot that reality even. But I'm looking at various metrics, not merely that if all these metals are 4 times their price in 1980. Well, they're not stopping either. Copper's continued 6 times where it was in 1980 right now. Okay, 1980 was $1. Okay, so the point is that silver, if it's compensating for that major error, pricing error, relative to anything, relative to all these basket of base metals, gold, etc., it likely will do it with speed. And I suspect that when that event occurs, and I think it's coming, I think when we come up out of this congestion, and already we have signals that we're coming up out of here. Okay, you can wait till the new high if you want to. But on the other side of this congestion zone will be something that will drop jaws. And be so rapid, so quick that people just won't understand it. But at that point in time, I'm going to bet that certain other fundamental factors come into play that already are in play, but have been long ignored by investors and analysts and talking heads on financial TV. Mainly monetary crisis, debt crisis, government debt crisis. We haven't had one of those in a long, long time. Okay. In 2008, the markets collapsed. Silver and gold went up, 2000 through 2011. But the stock market went down because of what? A debt crisis, but it was just mortgages. This time it's government bonds. This is a nuclear event. And it's only now marginally becoming sort of a sideline issue on financial press. It's so major, it should be the front headline. It should have been for a year now. The Japanese went into the hole, and now suddenly we're going into the hole with them. In fact, we're helping fund them try to get out of the hole. We're printing money to support the yen, so they'll continue to hold bonds, like a circle there. Okay, it's a game, but it involves what? Printing money. That's what moves monetary metals. But that other side of that move in silver, when it occurs, I suspect you're going to start to hear the fundamentals that really matter. And I don't just mean the increasing demand industrial for silver, but I'm talking about the monetary crisis. And those headlines will suddenly come up to the fore, but silver will then be 150, 200, 250. And all of a sudden people say, oh, now I understand. Okay, that's usually the way it occurs. It rarely is that all the real truth headlines come before the move occurs. It doesn't happen that way. It usually comes later, and I suspect that's when silver will look like a wet bar of soap.
The sponsor of today's episode is ARC Silver Gold Osmium. Owner Ian Everard is praised even by his competitors as one of the most honest and level-headed bullion dealers in the United States. They have some great prices. You can see some of them displayed right now on screen. Take advantage of these specials today by reaching out to Ian at 307-264-9441 or by email at ian@arcsgo.com. Make sure to tell him, of course, that Commodity Culture sent you. And now, back to the interview. And at $1,000 silver, in such a world, people would also counter that, okay, everything's going to be so expensive at that point. We're going to need a real kind of collapse of the monetary system, perhaps hyperinflation to bring on a price tag that high when it comes to the silver price. Does something need to go disastrously wrong in the global economy and monetary system for us to get to 4-digit silver? Or is there a way there without these sort of dislocations occurring?
We're already there. It's just that nobody acknowledges it.
Right.
Jamie Dimon does. He said months ago, we got a bond crisis. We're going to have to deal with it. Okay. In other words, you can't keep pushing this thing down the road every 10, 20 years. We'll take care of it again. It's been going on for like a century now. And finally, it's reached a point where the Japanese have suddenly, like the prime minister over there said a year ago, we're going to print. Okay. And I know our current president would like to do that as well. Whatever it takes, keep that stock market up. Okay. And the Fed has already begun because they've been supporting the yen artificially. And that has helped expand the money supply. So I think those headlines will come, but we already are in the crisis, really. What we're going to hear later is the wave effects of the crisis. we're what, for example, at MSA, we're not just watching like things like AI and semiconductors. Although we did give a good call on the semiconductors at the top. We're not far off the top. We said, that's it. Okay. The real issue is this underlying multi-decade government debt crisis and the jeopardy of the fiat currencies, not just Japanese yen, but us, Europe. We're all in the same soup. And it's just a matter of degree and when. Japanese first, us second, Europe's going to be next. But fiat currencies in a crisis like this will come into severe doubt. People will say, well, this has been kind of neat for the last multiple decades, about 100 years or so, but it ain't working. It's not backed by anything, and it's out of control, and all we keep doing is printing more of it. And, I probably said it on your show before that, when your granddad built a house, it was 4,500. When your dad built one, it was 45,000. Now a median home is 450,000. What does that reflect? Okay, degradation in the money unit. Okay, the stock market right now, S&P, for example, you go back to the year 2000, the dot-com high. Look at the multiple gain in the S&P, where it is now versus then, and then go back and look at an M2 chart and see where M2 money supply was in 2000 versus now. Oh, S&P has matched the decay in the money unit. That's all it's done. The S&P, I can't buy more loaves of bread now than I could back in 2000 with the S&P. Gold has massively beat that, stayed ahead of it. It's held its value. Silver's lagging, and that's where we get the slingshot. But anyway, it's going to be very interesting because there are many fundamentals out there that are all interconnected with this debt problem and the fiat currencies that will suddenly pop into play. We're watching financial sector. I mentioned the AI, which everybody's watching, and semis is the most watched thing. But you got to watch the financials and the key banks and also the commercial real estate market. ETFs like RWR, VNQ. There's something wrong there. And you can't allow, the Fed can't allow, any headline story to come out of a large bank. No, we're not going to go under because they'll print the money. But you can't have a major debt story about, major credit problem here. Another one. Oh, another one. Suddenly, the entire view of the investor public will shift. And they'll realize, they'll be ambushed, in other words, by a reality that's already been there.
So if silver is going to enter a new reality, what is that going to do to the silver mining space? Because we've seen both gold and silver miners take quite a hit post-Iran war kicking off, including some wacky stuff like the big gold producers reporting record quarterly earnings and then dropping in the aftermath. Seems there's a real disconnect between price and reality at this point. When it comes to the silver miners specifically, is that a sector you're particularly bullish on given your outlook for the silver price?
Oh, yes. I'm rampantly bullish on the silver miners. My own personal investments, which are disclosed at the end of each report, disclaimer, are heavily in silver bullion equivalents and silver miners. I also own some GDX, it's an ETF of gold miners, though it has 20% silver miners in it too. But there's an event there that is extremely important. All of the primary entry points to go long silver that we have recommended are well below the market. So in other words, if you're buying silver now, yes, you're probably doing the right thing. But on the other hand, you've really missed the opportunities that came starting in 24, 25, and in late 25. There were 3 buy signals. The average price of those 3 buys was $38. Okay. But there is another technical that's about to snap into place, we argue. And when it does, the temper and tone and verticality of the gold, the monetary sector, especially the miners, will go absolutely crazy on the upside. And I'm going to argue that probably when that occurs, that's when you're going to start to hear the stuff that motivates your average latecomer investor into saying, gosh, I got to own some of that. And it's like a wet bar of soap time. Grab that thing. The spread relationship, the relative valuation relationship of miners to an ounce of gold. You could plot that thing. We go back and use XAU index, Gold and Silver Miners Index, Philadelphia, because it goes back to the 1980s. So we've got a lot of history there. And when you plot it, you'll see that if you divided the price of the XAU index into an ounce of gold, that during the 1980s, 90s, 2000, up through 2008, the average was 25%, meaning that XAU was at least 25% of an ounce of gold. It went up to 35 at one point and it got as low as about 17, 18%, but it lived in a range for decades, the average of which was 25%. Okay. In the bear market that ended in 2015, that spread collapsed to 4%. I mean, okay. Average 25%, it went to 4. I mean, what do you think? We don't need gold miners anymore or silver miners? We go to 4%, it's like free. I mean, what do you want? Okay, it lived in a range for the past 12 years between that 4% low, never went back there again. The lows after that were 5%, to about 8.5% on the XAU divided into gold. So you had this huge collapse and then this dozen-year wide, perfect little range that when you plot it on a chart, you say, oh boy, break out of that and I'm going to buy it, okay? You're pushing up toward the top end of that again. You were there in February, and then the miners pull back relative to gold and in net price. And now they're quickly asserting themselves back up. Now, when we run GDX, which is the more popular gold ETF, its top end of its 12-year range is 2.2%. Okay, divided into an ounce of gold. Right now, it's back above 2%, charging toward the 2.2. If you get a monthly close on those spreads above the top of that 12-year wide range, there is a technical void in that chart where you could double the price relative valuation of the miners to gold just to bump the bottom end of the prior multi-decade range. In other words, go back to the old lows, okay, is what I'm saying. You would more than double the price, the relative value. Now, there's another fact in that spread. And this is important. This is why it's net price important, not just relative performance important. Whenever the miners are beating gold, even during the swings within that little 12-year wide range, with upswings and downswings, whenever it goes up, it means also that the net price of both is going up as well. It's never the case that the miners beat gold in a down market. So when that spread breaks out, it's also telling us not only are the miners going to revalue themselves rapidly and large, but they're likely to do it with extreme speed. So all this fits into what we were talking about before, about an acceleration, catch up, new reality for silver. The same is going to be true with the miners. So while gold is the mama, and silver does move with gold. People say, no, it's not, it doesn't move. Silver does not correlate to the commodity index. It correlates to gold swings. So that's an error on their part. But anyway, I think that's the stick of dynamite you got to watch right now, is the breakout of the miners on a relative basis, spread basis versus gold. When that occurs, I think it's helmet time. And you'll see a lot of latecomers suddenly rushing in. They'll start hearing the headlines that we already know exist. The earnings are off the page. The profits are off the page for the miners, and yet it's been ignored.
Yeah, you're echoing some sentiments that Rick Rule said on this show recently, because he was pointing out you don't even need to go out on the risk ladder and get into the explorers and the developers. The biggest and the best producers and royalty streaming companies are trading, in his opinion, at prices that he called a gift to God for investors. He talked about Agnico Eagle. He talked about Wheaton Precious Metals, Franco-Nevada. I mean, at this point, could someone just buy the GDX ETF and still capture that kind of outperformance of the market as a whole, right?
Yeah, that's one way to approach it. You could basically just sort of throw a dart at the sector and say, I don't know which ones are going to do better. Now, we do, in fact, every month sift through the miners to try to find the outperformers, the ones that are beating the sector ETF. But you could probably just throw a dart at it and buy an ETF like GDX, which is only 20% silver miners, or SIL, SIL, Global X Silver Miners ETF, which is focused on silver miners. And you will vastly beat gold. Now, I don't know they're going to beat silver, but gold, while it's the mama monetary metal and it's going up big, these guys are going to go up a lot more. Now, it's an issue about where's gold going, the mama. Okay. I've said this before, but you go back to the history of gold since it was, quote, legalized in the U.S. There was a bear low in 76 that went up to a high in 1980, and it was an 8-fold move. Price of the bear low to the bull high, 8 times. Okay. Different duration bull market, but from 2001 to 2011, gold had another 8-fold move from a bear low to a bull high. Where's gold right now? Well, the bear low was 1,050 in 2015. We're 4-fold. So if gold even just said, oh, I'm going to do it again, have yet another 8-fold dimension move, then you'd talk at $8,000 to $9,000 gold just to match the dimensionality of those 2 prior moves. What if gold goes further, which I think it likely will, because I think we're facing something we've never faced before. I mean, gold's got up due to the monetary expansion, inflation, et cetera, et cetera. Inflation is defined by money growth, okay? This time we have a monster, a nuclear event with the government debt market, because when they have to print to keep that house from burning down, it'll go off the page. And people will then say, well, goodness gracious, I thought, it was 60% stocks, 40% bonds, it was a balanced portfolio. Oh, that's right. The CIO of Morgan Stanley about 6 months ago said, no, it's 60% 2020 bonds, gold. He brought gold into the equation. I don't agree with his percentages, but his recognition of the reality was very bold. Gold must be in your portfolio. But what if bonds don't work? What if the stock market's topping, as we argue it is, and it won't take much to really get it going on the downside, like, a 10% drop will cinch that it's topped. I think that will occur. That will further motivate the Fed into printing. But then when you say, well, I'm going to go to the alternative that usually is a safe place to be, it isn't T-bonds. They're horrible looking. Look at the price chart. Look at the yield charts. And they've just begun. We're entering what probably is going to be a bond market panic. And of course, we know what the Fed's going to do during that time. There'll be no limit to what they do. And that leaves you with what alternative? Money, gold.
When it comes to the broad market, do you think that it might be able to stay afloat far longer than people realize, simply because of the different factors today versus previous major drawdowns? I guess the last big one would have been the GFC. The fact that there's so much passive inflows into these index-based ETFs, the fact that the US government now seems willing to take an actual stake in companies. What's to stop them from taking a big stake in the Magnificent Seven, for example, to kind of keep valuations elevated for longer? Obviously, it can't go on forever, but do you think there's an argument to be made that this extend and pretend that they've been doing with the debt can kind of also be applied to the stock market?
No, I think it'll be, I understand what you're saying. Well, we could go to a Weimar Republic. Why not? Everything goes up. Loaf of bread doubles every week or whatever, the stock market. The issue won't become whether it's going up, but what's going up more. In other words, on a spread basis, where should I be? And gold is already beating the S&P and nobody acknowledges it. It's higher than it was over the last 10, 15 years. Gold is. And yes, it's had a pullback recently, but it's starting to reassert itself. And I think it's going a lot higher, gold relative to the stock market. But the fact that government enters to try to support something doesn't help. History proves that. Let's go back to .com high. They've been raising rates. People think raising rates is bad for the market, lowering rates is good. It's totally opposite almost. They were raising rates in 99 to 2000, and the market was going up. They quit raising rates in, I think it was early 2000, and the market then started to top. .com went down first, NASDAQ 100, for example. S&P hung in there. We are starting to see that spread break now, by the way. And in 2001, 2 times in the first month, January 2001. The Fed cut rates and cut rates. They cut rates all the way down, yet the market dropped 82% in the NASDAQ and 50% in the S&P. They cut rates all the way down. So cutting rates isn't necessarily good for the market, right? Okay. Same story back in 2007. So people say, well, the Fed, if they do this, that does that. Okay, well, they're usually totally wrong, that assumption. They cut rates in mid-September 2007. S&P was near its highs. First rate cut in a long time. It shot up for about 3 weeks into October 2007 and peaked. We had a target zone, right in our target zone where it peaked. They cut rates all the way down. They even did a QE in November 2008. The market still went down to March 2009. 50% drop. They cut rates all the way down. It didn't help. What did it help? Gold. Gold was going up from 2000 to 2011. Yeah, there was a stumble in 2008, but it basically was a massive bull market. Fed was printing. Didn't help stock market. So the question is now, well, can they do that again and it maybe have a different result? Well, if they go crazy, maybe it can. But there's a point at which even the investment public, which is usually lagged to reality, says, I've had enough of this. The risk reward is sort of depleted on this one. I'm going to move over to some place that looks better, that's been doing better. And if the bonds don't work, then if they listen to the CIO of Morgan Stanley, they say, well, I guess I better buy some gold. So I'm not so sure that even if they did that, and by the way, buying into companies, I hate to get into this, pardon me. I'm not blaming Trump because a lot of presidents have done this before, like bail out General Motors, et cetera, where the government spends your taxpayer money to, in effect, invest in a company. This is Mussolini's version of socialism.
Yeah.
Instead of taking over the company and seizing its assets like the Marxists would do, he said, no, we're just going to sort of partner with them and tell them what to do, but not really own them. And we're going to control them in many different ways, and yet it still will be, quote, private. And so government taking your money and putting it into a stock, don't bet on it working. Where they put their money doesn't always work. They like 2000 to 2002 stock market, 2007 to 2009 stock market. They put money in with cutting interest rates, flooding the market with cash. It didn't help. So no, I wouldn't count on that working.
Well, I think that's a great segue into touching once again on your book, which we've talked about on this show before, Anarcho-Capitalism. It's essentially a thesis on running a country without a government. Very insightful read. I'm going to put a link in the description below. I really recommend people pick it up. Very, very easy to read as well. Very clear the way it lays out the thesis. Now, given how everything is playing out right now across the world, societally, economically, politically, some would throw spiritually into that mix, are we getting any closer to an anarcho-capitalist world where government can actually be taken out of the picture?
First off, that book, which was, according to Murray Rothbard, died in mid-1990s, is the father of modern libertarianism. I knew him personally, and we communicated. I met him one time personally and interviewed him in a paper I was running, but also by letters. And he told me that my work would be the first one on the subject of anarcho-capitalism, attempt to define it from bottom to top, not just an essay on certain. I'd written in 1972. So it's a long time. I'm not active as a libertarian. I'm not active in the movement. The book has a life of its own. The concepts are there. But we've seen recently, the question is, will it emerge? I don't know. We know that the man gropes for truths throughout history. And he builds institutions and they last for a century or 1,000 years. And then for some reason, they're dismissed because they don't work right. And man evolves to something else. And this is a constant process. So change is constant. Okay. So people who sit back now and say, well, certain institutions are just here forever. Like, the founding fathers defined what the U.S. would be, well, as if that's been followed, but, presume,
Right.
Okay, it hasn't. But things come and go. And now with information transmitted so rapidly, as opposed to, a couple hundred years ago, you want to find out what's going on, a ship has to carry the newspaper across the ocean before you know it. It wasn't even telegraph. Okay. But now we communicate rapidly. So everything is instant knowledge, good knowledge, bad knowledge. But anyway, it's instant. Therefore, things that go wrong quickly get identified. Now, they may not know the real cause of it going wrong, but there's a focus on it. So things can shift more quickly now than they used to. And there's a book I've not read, but I understand some of the basic thesis of it, The Fourth Turning. Okay. To some extent, that's what I argue in anarcho-capitalism, libertarianism, the new libertarianism, anarcho-capitalism, is that ultimately, if ideas are wrong and institutions are built on ideas that are not correct or they're somewhat dysfunctional, over time you'll find that out. And then man will hopefully, in a positive evolutionary direction, say, let's get rid of that institution. That hasn't worked. And now we're in a speedier world where these kind of things can happen far more quickly than over the span of decades. They can happen in a year or two. And particularly when we have not localized, but we have the entire, what we call the Western world, including Japan, okay, all our allies. We have great government debt beyond off the page, no way to pay for it except print. And obviously it's an error and it creates all kinds of problems. It is inflation. CPI is a secondary measure of inflation. Inflation is the increase in the money supply, the degradation in the money unit. Well, that's universal now in those countries. And that has wave effects that hurt people. Cost of food. It's not just the war in Iran. In fact, oil is relatively cheap still to its own history. But the overall rise in cost of living, rents, building a home, et cetera, yes, that hurts people, but it's not caused by one war event. It's caused by the degradation of the money. The question then is, well, what do we do about it? Well, I'm not arguing that it's going to happen, but there is one instance that it has. Argentina used to be the 7th biggest economy in the world, 50, 70 years ago. And it devolved into a statist society where high inflation, high unemployment, great levels of poverty, huge government debt, a very stagnant economy. You'd call it a third world almost, developing economy. Javier Milei got elected president, I think it was 2.5 years ago, maybe longer than that. He declared himself, he's an intellectual, by the way, he's not a politician. A young guy with hair looks like a rock star, Anyway, the youth vote went for it because they wanted something to change. And he said, I'm going to change things. It's no longer going to be this established party and that established party just competing about how much socialism we're going to have. So Argentina had extremely high inflation, extremely high government deficit, extreme poverty, housing costs were off the page. And since he is an academician who defines himself as an anarcho-capitalist, which takes a mental effort, because you didn't just say I'm a libertarian. I'm an anarcho-capitalist. Some of the data points I wrote down the other day that are even acknowledged by the mainstream press. There was an article by Newsweek a year or so ago, online Newsweek, that cited the dramatic change he's made in the housing costs in Argentina for the poor people. First off, poverty in Argentina dropped from 54% to 28% since he's become president. The housing market was originally controlled, quote, by the government that's out to protect you. They had rent controls, okay? Well, they had an extreme shortage of housing and very high priced. In the last couple of years, that has collapsed. Housing prices have collapsed and the quantity of rental homes is exploded because he's taken the restraints off that industry. And so the average guy can now afford an apartment or a home. The inflation rate went from 100% down to 32 since he's been here in 2 years, okay? Poverty rate, 54 to 28. And the government budget has been in deficit for like a century. It's now positive. Okay. So nobody notices this. And yet it's one of the kind of things that man might say, well, hey, that old stuff didn't work. Let's try something new. And we'll see, over time, people may turn their heads and say, what's this guy done? How did he do that? I don't know. I'm not advocating. We're analyzing markets. And frankly, I do not let my political philosophy influence my timing and trend assessment of gold, for example. Yeah, gold goes up all the time during degradation of money units, but it does it in waves, and we like to avoid some of those sustainable waves. So in 2012, right after the 2011 high, we turned bearish and stayed bearish till 2015. So despite the fact that I love gold, okay? But anyway, so I don't let that influence. So listeners, don't confuse my thoughts on that subject with our analysis. But yeah, we could end up with that kind of thing. Who knows what's going to happen?
Yeah, some great thoughts you've laid out there, and that also segues perfectly into momentum structural analysis and what it is you do. Why don't you tell us about that and how people can sign up for the service?
Well, we look at all the major asset categories. Especially today, it's important because you can't just say, I'm going to own gold and look at it only, or silver, or whatever. You've got to look at these other waves that are generated out there because they're going to impact gold one way or another. Mostly positive, by the way. So we analyze the stock markets, not just ours, but China, Europe, etc. We analyze the government bond markets. Especially important today, especially important. We analyze sectors within the stock market, like, everybody's looking at AI and tech. I'm looking at financials. You can't; those guys can't stumble. If they stumble, the game changes. Central bank, they don't care about AI. They care about financials. Okay. We also look at the bond market and forex. We look at forex markets as well. So, and commodities, broadly commodities. That, by the way, which is an investment grade arena to consider for the next several years. I know it's not going to be as hot as gold and silver, but it looks like it has great percentage gain over the next several years. And it's broad. It's not just because the oil goes up, or in fact, oil's a laggard within that category right now, or grains go up. It's because the entire basket of commodities is basically rising. In other words, money is flowing into that cheap category. Probably some of it coming out of the stock market, and more so if the stock market breaks more, then that flow will go somewhere else. And right now, that is a basic asset category that it looks good, especially the stocks that are related to the commodity production, grain related, oil related, base metal related. Anyway, that's what MSA does.
Great. Well, I'm going to put a link in the description below to Momentum Structural Analysis so people can check it out, sign up for the service. Michael, as always, amazing conversation. Thank you so much for coming on.
Thank you, Jesse.
Thank you for joining us here. If you're looking for great prices on gold and silver bullion, look no further than ARC, Silver, Gold, Osmium. Their specials are displayed on screen right now. These are subject to change, and while supplies last, so reach out to owner Ian Everard today at 307-264-9441 or by email at ian@arcsgo.com. Make sure to tell him that Commodity Culture sent you, and join the Commodity Culture WhatsApp group. It's free. We're sharing all sorts of interesting investment ideas. There's debates, there's polls, and it's a direct way to access me and ask me questions as well. The link is in the description below. Join today, and I'll see you guys in the next episode. Commodity Culture is a series on commodities and natural resources. If you would like to see more, be sure to subscribe and hit the bell notification so you're always up to date with the latest episodes.